Good morning. So today we are going to start about the portfolio evaluations performance measure. So what is the portfolio evaluation performance measure? How it is going to measure? The evaluation of portfolio is entirely depend upon both the returns and risk. So it is very difficult to integrate both these factors into an index in order to evaluate the portfolio. So previously, portfolio we have evaluated based upon the rate of return, movement of risk and uncertainties that can be identified, but it is not possible to quantify the risk. So, sorry, excuse me. Different models for the portfolio performance measurements has been developed by the Sharps, Trencer, Jensis, and others, which has been taken into consideration for both risk and return. And it is also going to enable to rank and set off a portfolio and make comparison with the market standard. So, as per these results and these models is going to indicate both risk and returns to access the performance of each portfolio. So, what is the importance for this evaluation of portfolio? Why there is a need, a requirement for the portfolio means it helps the investors to highlight and to know the relative performance of their portfolio. It going to provide the information to the investors which they needed for rebalancing of his investment. It provides information to the management that may facilitate them in evaluating the portfolio of performance, as well as manager is also going to get the assist in comparing the performance of the different managers. It helps in determining the compensation of portfolio management as well as comparing funds on the basis of risk adjusted rate of return. Lastly, it is going to provide a benchmark for comparison of funds which have been giving a result or outcome. Results or outcome. So here, these are the certain purpose or requirement for portfolio evaluation. So here, portfolio evaluation requirement need we know. But what are the different types of measures will be available for evaluation of portfolio? As I said that these models of portfolio has been developed by the SPTPJP, that is Sharps, Trencer, and Jensen's model. So you are going to expect these problems in these units, SPTPJP. So in detail, we are going to learn about each and every portfolio evaluation. First, Sharp's reward to variability ratio. So here, the performance measure is entirely developed by the William Sharp, and it is refers to the Sharp ratio or the reward to variability ratio. It is a ratio of the reward or the risk premiums to the variability of the risk and returns, which will be measured by the standard deviations. We are going to be evaluating this Sharp's method with the help of the standard deviation. That is nothing but a variation or a difference. So here we are having a formula for SP, that is SP is equal to RP minus RF divided by sigma. I'll share the notes in the group now. Okay. SP is equal to RP minus RF divided by con portfolio. This is the formula for the Sharp's ratio. So here, with the help of a small problem, so this is the formula, formula, and this is the problem for your Sharp's ratio. Okay, I'll explain. Sharp's ratio. So here, Nitya is one of the firms. She's trying to decide 2 out of 4 investment funds. From the past performance, they were able to calculate the following average returns and the standard deviation of these funds. So they have given information about the average returns of the 4 funds and standard deviation. What is the formula? RP minus RF. So return on each securities is 17, 18, 16, 14. And standard deviation is 19, 20, 13, 12. So RP minus RF, risk-free already in the problem they have given as a 9%. So the 17 minus 9 divided by 19 is going to give the risk portfolio evaluation as per the Sharp's model. So as per this, we are going to compare the SP of 4 funds. So first fund is giving a 0.4, second fund 0.45, 0.53 and 0.1. So here with this information, if you look at Nitya has been advised to choose the two fund, that is Minu fund and Minu fund, because their performance is better than that of other two performance. So here Minu fund is been performing zero with 0.53%, and Minu fund is been performing with 0.4%. So this the best portfolio for the Nitya is Minu and 4 by providing the benefit of 0.5, that 53% and 45%. This is a small case of the Sharpe's model. Next, Trench's reward to volatility ratio. We can call it as a TP ratio. So the performance which we have been evaluating developed has been developed by the Jack Trencher, and we are called as a Trencher ratio, or reward to volatility ratio will also concern. So it is entirely concerned with the systematic risk or a beta. So that's the reason it is going to provide the relationship between the reward or risk premium to the volatility of the return, and we are measuring with the help of the portfolio beta. Here in Sharpe's model, we have evaluated the standard deviation. Here in Jensen's model, we are evaluating with the beta of the portfolio. Okay. Formula for this. Formula for beta RP minus RF divided by beta of portfolio. Similarly, same will be there for the RP minus RF, how we are having a Sharpe's model. Here, beta portfolio will be different. In Sharpe's, we are having a standard deviation portfolio. Here, we are having a beta portfolio. So here, we'll having one more example, which is entirely based upon the Princess model. So here, the information which has been provided regarding the performance of the mutual funds of a Birla Advantage and Sundaram Growth and Sunf C value of the period of the time for the 6 months period of time. So here they have given information about the three companies, returns, risk, as well as the beta of the portfolio. So with this return and risk, we have to evaluate the Trench's model of the portfolio. So I'll explain. So here, what is information? The following information has been provided regarding the performance of the funds, namely Birla, Sundaram, Growth, and Sun FC values for the period of 6 months ending the 1999 of August. So the risk-free rate of return has been assumed 9%, and we have to rank by using the Sharpe's model. So they have given the return on portfolio SP as well as the beta. So the formula for the SP according to Sharpe index model, SP is equal to RP minus RF divided by risk on portfolio. So RP returns are your 25.38, 25.11, 25.01. So returns we have been taking 25.38 and 25.11 and 25.01. RP. RF we are having in the question 9%. So we are taking 9%, 9% common divided by risk on portfolio. So risk on portfolio is your, here they have indicated with 4, 9.01 and 3.55. Okay. So here these are the written as per the Sharpe's model. Similarly, as per the Trench's model, RP minus RF divided beta of portfolio. Here beta of portfolio, these are the beta of portfolio. Only the denominator part will be changing beta. So they have considered this. So as per Trench's model, 71.2, 28.2. So if you look at, as per the Sharpe's model, SunF and C funds ranks top among the three because higher rate of return and low volatility of return. And as per Jensen's model, Birla Advantage having a high value due to its high risk premium, that is 25.38 and low market value. So here, as per Sharpe's, SunF and C companies performing well, and as per Trench's, here Birla Advantage is performing well. So this is a small example for the Sharpe's model. Just wait and take the screen. Okay. Next is your Jensen's model, or we can call it as a JP, Jensen's differential index. So the performance measures which have been developed by the Michael Jensen's, we can refer as a Jensen's measure or ratio. This ratio is always attempts to measure the difference between the actual returns which have been earned on the portfolio as well as the return expected from the portfolio. So here, when we are been evaluating the CAPM, which is used to calculate an expected return on portfolio, the difference between the return actually which have been earned on the portfolio and the return expecting from portfolio is a measure of the excess of return or the differential returns that has been earned over and above the systematic level of the risk. So this differential returns, which is going to give an indication of the portfolio manager for the predictive ability or the managerial skills. So here, based upon the CAPM model, we are been evaluating the return on portfolio of Genesis model RF plus beta into RM minus RF. So this is a formula for the Genesis model by using the CAPM. Okay. So with the help of small example, I'll share. Genesis alpha and the beta coefficient for the four stocks we have to calculate. So here they have given three companies information: Kraft, Levers, Berries, and Hopkins Corporations. So the alpha rate they have given and the beta rate they have given. We have to rank these four stocks by using the Genesis performance. So formula for the Genesis performance is your first we have to evaluate the coefficient of alpha and coefficient of beta. So 1 divided by 0.9, and these are the values for the four stocks. Okay. So here we are evaluating only the values of the four stocks based upon the coefficient of alpha and the beta. Okay. But when we want to evaluate the portfolio evaluate performance, we'll be considering the CAPM return. So in the coming problems, I'll explain how we are going to evaluate the CAPM return of the funds of the both the portfolio. Three considerations. So here this is example. Considering the following information for the three mutual funds, ABC and the market. So ABC mutual funds, returns they have given, standard deviation they have given, and beta. ABC returns 15%, 17%, 19%, 20%, 24%, 27%. Beta is 0.90, 0.10, 0.10. And the market index is 16, 20, and 2%. So here the mean risk-free rate was 10%. We have to calculate the Sharpe's measure, Fences measure, and Jensen's measure. So in simple terms, we can call it as SP, TP, and JP, or else evaluation performance of the mutual fund portfolio also we can categorize. So if you look at the formula for things is your Trences is RP minus RF divided by beta of portfolio. So fund A, B, and C. RP return on portfolio 15%, 17%, and 19%. 15%, 17%, and 19%. Next, your RF is 10%, 10%, 10%. In the problem, they have given 10%. Divided by beta of portfolio. So, beta is 9, 0.9, 1.10, 1.20. So, if you, with the help of Trences model, we got the values 5.56, 6.36, 7.5. And the market index also we have to consider, that is 16 minus 10 divided by 1. So, market is also 6 with the help of Trences model. Then we are applying for the Sharpe's model. We know the formula RP minus RF divided by risk on portfolio. So fund A, B, and C market index 15 minus 10 as usual. RP minus RF will be common. So here we are using the betas of the portfolio. So standard deviation of the portfolio. So standard deviation of the portfolio, these are the funds. So we'll considering the same standard deviation 2024. And market index also we have calculated. So as per the Sharpe's model 0.25, 0.29 to 0.3333, 0.3. Okay. This is a return. Jensen's measures formula is RP minus RF plus beta into RM minus RF. So here this RP is same. Minus we have to do the return of CAPM. Return of CAPM formula into RF plus beta into RM minus RF. Okay. So here return on portfolio for four funds is 15, 17, and 18 as usual. Minus RF 10% they have given. Plus RM return on market 0.90 already in the problem they have given question. Next, beta RM return on market they have given. Next, RF in the problem they have given 10%. So if you are applying all these things in the values, we got the minus 0.4, 6.4, and 1.8. This is the performance evaluation of the mutual funds by using SP, TP, and JP. Okay. Next, what is the meaning of this mutual fund? What is the origin or the history of these mutual funds? You can expect this question for your theory also. You can expect one theory and one problem from the fifth unit mark. So as per the mutual fund, so that according to Mutual Fund Act book, which has been published in the investment company, Institute of US, a mutual fund is a financial service or organization that receives money from shareholders, invests its earns return on it, and it is going to attempt to make it grow and agrees to pay the shareholders cash on demand and the correct value of the investment. So as per the SEBI Mutual Funds Regulations 1993, mutual fund, the fund which has been established in the form of a trust by a sponsor to raise money by the trustee through the sale of the units to the publics under one or more schemes for investing in securities in accordance to these regulations. So it is a special type of investments which is going to act as investment conduct. So mutual fund is a special type of investment of funds which acts as investment conduct, and it is going to collect or pool the savings of the communities or the invest in a large funds which is fairly large as well as diversified portfolio of sound investment. It employs a professional quantified as well as the experienced investment consultants and fund managers who is going to take a pooled money and invest in a variety of blue chip companies which are been selected from a wide range of industries with an objective of maximizing the returns and income of the investment. So here the entire history, that means where from where this mutual funds has been developed means it is a it has been begun in Belgium in the year 1882 with the establishment of company name called as Societe Generale de Belgium, which finance national industries associated with the high risk. Gradually, this movement is spread to England during the 1860s, and in 1868, it has been spread risk for investors, foreign and colonial government. So here in USA, the history of mutual funds started in early 1990s, that is in the 20th century. The three investment companies has been organized, that is, they are Muscatis Investor Trust, State Street Investment Corporations, and US and Foreign Security Corporation. So in Canada, the mutual fund also started in 1920s, and the first mutual fund was set up in the year 1932 with the name of the Canadian Investment Fund. Later, a number of mutual funds has started in many countries of Europe, the Far East, and the Latin America also. In recent years, the performance of mutual fund is improving in Japan and the fast era of East due to the growth of their economies and capital market. Similarly, countries like Hong Kong, Thailand, Singapore, Korea, and also has been entered in mutual fund markets. Thus, a mutual funds has emerged as a global financial culture and holds a potential growth for the things. So, what are the main features of this mutual fund? So features of the mutual funds we'll be explaining with the help of certain elements, that is characteristic features. First one, management. So this management is consists of a professional who has expert knowledge and experience with relations to investment. They are able to manage the portfolio in an efficient way. They are able to manage the portfolio in an efficient way. Next, small savers. Here, the person with low income and low spending capacity can prefer mutual funds for saving small amount of their income. Here, the mutual funds enable the small investors to invest their funds in its wide range of products. In its wide range of products. So here, as per the mutual funds, liquidity is also considering as one more important features. which is going to encash at any time by considering their present net asset value plus additional fee or charge, if any, applicable at the time of redemption. Next, diversification. The mutual funds diversify the funds. The funds which have been diversified in mutual funds are invested in various stock. Since every stock does not have the same returns, that stock, the return could be a risk, could be a diversify by investing in large range of stock. Analysis and selection of portfolio. The growth scheme of mutual funds involves the pooling of large number of equities. So these schemes bear greater risk and also associated with the high potential for the generation of capital revenues. The mutual funds also provide income schemes. Under such schemes, the funds are invested in shares that ensure guaranteed returns. Basically, bonds and debentures are selected. The growth schemes are close-ended, whereas the income schemes are either open-ended or close-ended schemes. Next is your purchase or professional management. In mutual funds, the funds are invested into securities which will be evaluated, monitored, selected by the professional managers. They even carry out regular reviews with relations to these investments. This ensures higher returns to the investor than the individual investments which have been made without the assistance of the professional experts. We are having a different types and schemes of mutual funds. Different types of mutual funds. We have been classifying the mutual funds based upon the classification by structure, classification by objective, classification by nature of investment, classification by portfolio, classification by geographical boundaries, and other schemes. When we consider classification by structure, open-ended scheme, close-ended scheme, exchange-traded scheme. Next, by objective, growth fund, equity fund, debt funds, balance funds, and money market fund. When we consider for the classification based upon the nature of investment, gilt edge funds, commodity funds, real assets fund. By portfolio, bond funds, stock funds, leverage, special, index link fund, and dual purpose fund. Classification as per the boundaries, that is domestic mutual funds and offshore mutual funds. Other schemes means definitely it is a tax saving schemes and fund of fund schemes. So in detail, one by one, we'll learn because this is also expected question for the 12 marks. So based upon the classification of structure, we categorize into open-ended, closed-ended, and exchange-traded fund. Mutual funds which have open-ended schemes under which an investor is free to join the fund and withdraw from the fund at any time from the initial lock period in the period that is called open-ended mutual fund. Closed-ended mutual funds. Such mutual funds does not issue shares or units or purchase or repurchase or redeem on a periodical basis. Units of such schemes can be redeemed only on termination or through the dealing in secondary market. Exchange traded fund. Exchange traded fund. A mutual fund provides the benefits of both ended scheme, open-ended scheme and closed-ended schemes is called as exchange trade fund. These funds are popular in abroad, but recently introduced in India also. They can be traded throughout the day. So we can have at any time throughout the day we can trade. When we are categorizing based upon the objectives, first is growth fund. This growth fund have the principal objective of capital appreciation of the investment over a period of time. Next, equity funds. These funds are established for those who are willing to accept significant risk in the hope of very high return. Debt funds. It is provided a fixed return of those who desire safety. Balanced fund. Some mutual funds are called balanced fund, where assets are judicious mixtures of industrial stocks and bonds. Balanced funds. Some mutual funds are called balanced funds, where assets for these are mixture of industrial stocks and bonds. Money market funds. These funds are used in short-term liquidity assets like certificate of deposits or commercial paper. For them, capital is raised by selling the shares to the investing public at a price which is equal to the asset value of the existing share outstanding. plus loading fee or service charge. This is known as a highly liquid assets fund with low risk and virtual no capital loss will be there. When we are again categorizing based upon the nature of investment, the first one is a gilt funds. This scheme invests only in government because gilt hedge funds we call as that is RF or risk-free return we can call as a. So here this scheme invests only in government bonds, that is major parts of nearly 80 to 80% is invested in government bonds and other balance will be invested in 10 to 15% of investment in cash. These schemes are also called as government securities, which involves investment that has been made in gilts of different maturities such as long term, medium term and short term. So we can consider GS57, Tata GS57, UTI government securities are the example for these gilt funds. Next, commodity funds. The funds which are invested in precious metal like food grains and other traded commodities are called commodity funds. Specialized commodity funds are invested in a single commodities, whereas diversified commodity funds are invested in all available commodities. Real estate funds. Real estate funds are a kind of close-ended type. This fund is named so because they invest in the funds in real assets, which is called ventures. Such funds are various types. So real estate funds are the kind of a close-ended types where the funds has been named because they invest in real estate ventures. Such funds are various types which are depending upon the real estate transaction. So when we have been classifying the classification based upon the portfolio, so we have been survive with in order to meet it varied objectives of different types of investors. So here two mutual funds schemes are not same, they're entirely based on their portfolio, which have been classified. That is bond funds. Bond funds, which is going to provide the fixed return for those who desire safety. The tax savings of investors are invested in various kinds of bonds in which investment is made primarily with an investment objective of safety. So these bond funds are more liquidity, diversified and conservative investment with a modest capital gains. Next, stock funds. These are the funds which are established for those who are willing to accept significant risk in the hope of very high returns. So these are also called as common stock funds. So which is going to held in the funds are entirely the common stocks for diversified list of industrial corporations. They may be further classified into another things, that is leverage funds or special hedge funds also we can say. Leverage funds or the borrowed funds, which is usually called as to increase the size of the value of the portfolio and the benefits of their shareholders where they are going to gain exceeding the cost of borrowed funds. Such funds we are used as a speculative and risky investments like short sale to like that to take the advantage of declining market to realize gains in the portfolio of a short sale. Special funds. These funds invest only in specialized channels like gold, silver, or in some countries also. Next, index link funds. These funds invest in only in those shares which are included in the market index and in the same proportion. Whenever the market index goes up, the value of such index link funds also goes up. Conversely, then when the market index funds comes down, the value of the such index fund also come down. Okay. So the next one is a dual purpose fund. Income and growth are the two objectives where which are being achieved by offering half of the amount of the funds to those investors who are wish to for the regulation of the funds and all. So here, when we consider these funds, Sorry, ma. Dual purpose funds. These are the income and growth of two objectives which are been achieved by offering half of the amount of funds to those investors who are wish to regulating income and half to those who are wish to growth. So these funds will be received by the pool together and used for investment. Any income derived from the portfolio is always goes to the investor who hold income and shares. The investor who hold capital. So the investor who holds the capital shares will receive no income. Instead of this, they will receive capital gains raising from the sale of investment of the total portfolio. Classification by geographical boundaries. National boundaries which have been provided territorial restrictions on the scale and purchase of mutual fund units as it is the case in commodity traded or services. On the basis of these facts, the classification is as follows. We can consider as the domestic mutual funds, offshore mutual funds. Domestic mutual funds are the saving schemes which are open from mobilizing SAMES for the nationals within the countries. The schemes may be of different types. So all the schemes is worked in the country by existing mutual funds, that is UTI, GIC mutual funds, LIC mutual funds, SBI mutual funds, Canara Bank mutual funds, etc. These are all we consider as a domestic schemes. Yes, sir. Offshore mutual funds. These schemes which are open to attract foreign capital for investment purpose in the country of issuing company are known as the offshore funds. They facilitate cross-border funds flow, which is direct route for getting a foreign currency without political string or domination on the issuer country. The investor have to take the currency and country risk. The major offshore funds are the UTI funds, which have been established, introduced in the year 1986, SBI Indian Magnum Funds, which has established in 1989, CAN Indo Swiss Himalaya Fund in 1990. The last categorizations or classification of mutual funds is based on the other schemes. So here, apart from all the which have been studied mutual funds, we are having some other schemes also, that is your tax saving schemes. Income generated from some specific mutual funds is not taxable. They are exempted under Chapter 3 of the IT Act in 1961. Example of the such type of a tax saving mutual funds are SBI mutual funds, Franklin Templeton mutual funds. These are the examples for tax saving mutual funds. Funds of funds, we call as FOF. So it is an investment fund which not invested in shares, bonds, or other securities directly. It is a portfolio consisting of a units of other mutual scheme. So investor get an advantage of diversifying these fund into a different mutual fund schemes. So this risk is entirely get minimized. Next, what are the various schemes which will be there under the mutual funds? So mutual funds, specifically, we have invested in three extensive main categories: financial assets, which are called as financial, which we have included in this. So here, when we have been categorizing into financials, stocks, bonds, and cash. So here, when investment is made in equity and equity-related instruments, then investment product are called as stocks. Bonds, these are the debt instrument which tends to mature more than 1 year period, such as treasury bonds, quasi government bonds, corporate debenture bonds, and asset-based securities. Cash, the debt instruments whose maturity period is less than 1 year period of time, that is in the form of cash. Well, the very good example for this is your treasury bills, commercial paper, certificate of deposit, and all. So here, based upon this, there are mutual fund schemes which have divided into three broad categories. First, equity scheme, hybrid, debt scheme. What are these equity schemes? Equity schemes invest about 85 to 90% of their total investment in equity shares or equity related instruments, whereas the remaining balance they get invested in cash. In India, equity schemes offered by mutual funds have been divided into five different subheadings. Those are diversified equity schemes, indexed scheme, sectoral scheme, tax planning scheme, arbitrage scheme. Diversified equity schemes, such type of equity schemes usually invest in a broadly diversified set of portfolio consisting of equity stocks of which are nearly 20 to 50%. Even more, they have been contributed by large industries. Examples HDFC, UTI, and Reliance Vision funds. Index scheme. This form of equity schemes invest their majority of the investment into equity stocks, which can be traded at various stock market index like S&P Nifty index and the SESWIT, where each and every stock is allotted with a weighted weight equivalent to its contribution to the overall index. Therefore, an index scheme may increase, decrease based on the tracking error similarity in the index. The main objective of this scheme is to generate uniform returns for the index. The example, UTI, Franklin, NSE index funds. Sectoral scheme, as the name itself is giving a suggesting, this schemes usually invest in a major share of investment in the equity stocks of the prescribed sectors like pharmaceutical, information technology, telecommunications, like that. So here investors are trying to attempt or attract by these type of schemes where they speculate about the growth of the specific sector. Examples are UTI, Petro, Franklin, Infotex, and Reliance Pharma Medicals. Next, tax planning scheme. These schemes are specifically meant for the individual and HUFs if as they satisfied the condition and standard limits as per prescribed under the section of 1980s of Income Tax Act. Such subscriptions needed to deducted prior to the calculation of taxable income. So tax planning schemes are also termed as say equity linked schemes, that is ELSS we can call. The very good example for the tax planning schemes are Franklin Indian, Reliance Tax Shield. Next is your arbitrage scheme. Generally, price of a stock on the spot or a cash market is less than its price in future market. Such difference in the market is going to exist between the interest element of the equities. This arbitrage is going to allow investor to gain the revenues by simultaneously buying the stock from the cash market and selling them into the future market. So the spread is nothing but the difference between your cash as well as the future price is going to become a zero. This scheme usually has a market nature stances which is going to be subjected to the market regulations. Hybrid schemes is invest in a partial investment in equity instruments and remaining in the debt instruments. So combinations will be there. Under that, first one is your equity oriented schemes. Under these, major part of the investments are made in the form of equities, that is nearly 60% of the portfolio, and the rest is invested in the debt instruments. HDFC is the best example for this. Debt-oriented scheme. This scheme is termed as a debt-oriented hybrid schemes because major part of the investment are made in debt instrument. The most popular debt-oriented scheme in India includes a monthly plan. It was consist of morely 85 to 90% of the bonds, only 10 to 15% equity components. The very good examples are your Birla MIP, Franklin Templeton Indian are the examples. Variation and variable assets allocation schemes. Under this scheme, the proportion of equity and the debt are mixed based upon the objectives extension. For example, see here, UTI has been introduced in index linked plans, which is a plan under UTI variable investment scheme. This scheme is an open-ended market scheme which involves the active allocation of assets between the debt and the equity under the varied market institution. The value of the equal position of variable allocation schemes decrease with a increase in the market and vice versa. Debt scheme. Debt scheme usually forms from the investment made in the debt instruments, either in the form of bonds or cash. The wide range of debt schemes are presently offered by the mutual funds in India. So we can further categorize these debt schemes into a gilt scheme, mixed debt scheme, floating rate, and cash scheme. Gilt scheme invest only in government bonds. That is major part, nearly 80 to 85% is invested in the government bonds and 80 balance on the 10 to 15% of the investment cash. So these schemes are also called as government securities, which involves the investment that has been made in the gilts of different maturities, such as a long-term, medium-term, and short-term. Examples for these are Tata GSC and UTIG securities. Mixed debt schemes. So these schemes typically invest in government bonds, corporate bonds, and cash. Nearly 30 to 40% of the total investment made in the government bonds and 40 to 50% are made in the corporate bonds, whereas the rest is invested in a cash. Examples is HDFC income and UTA bonds. Floating rate debt instruments. Okay. The scheme invests in a portfolio compared of floating rate debt bond, fixed rate bond, which can be swapped further floating rate returns and cash. Examples are your floating rate scheme or ICICI Prudential floating rate schemes. Cash schemes. Under these schemes, investments are made primarily in more money market instruments such as the treasury bonds, commercial papers, certificate of deposit, call money, and reverse repo and deposits with banks. Therefore, it is termed as a money market schemes and also called as liquidity schemes. These schemes do not have any allocation of around 25% in a short-term bond. Such schemes are being categorized by the average portfolio maturity less than of 150 days. Fixed maturity plan. Close-ended fixed maturity plans constitute the recent innovation in the field of debt schemes. They have fixed maturity period which ranges from 3 months to 3 years. They have indicated but not guaranteed assured returns. They have indicated with the things but not guaranteed. So this is primarily invested in the corporate bonds. Usually this will provide a higher post-tax returns which compared to the other competing interest instruments such as the fixed bank deposits and different types of bonds because they are found to be have an associated with several tax beneficiaries. What are the advantages of these mutual funds? Disadvantages. Advantages: diversification of portfolio, that it will be money will be invested in various categories and different companies. Professional manager. The investors who are in fear of investing into mutual funds can get the suggestion from the experts of professional money managers regarding what type of funds to be purchased, what type of funds to be sold, and when they have to purchase and sold all these things. Liquidity: investors can redeem it or withdraw for investment mutual funds with any point of times. With the dematerialization, it becomes more easy. Funds well regulated in the view of security and convenience of the investor. SEBI has issued regulations for working of mutual funds in India. It looks after these funds to ensure the transparency and all those things. Flexible and affordability. Mutual funds are flexible, that is, investors can reinvest their funds with switch funds from debts to equity, and they also affordable. They are all available in small units starting at the rate of 10 rupees. Tax benefits. Income generated by investing in mutual funds is tax free. So investors are going to get up to 20% of tax exemptions when they are investing in mutual funds. Disadvantage: wrong perception that mutual funds in India have been quite wrongly promoted as alternative to equity investing, thus creating a very high expectations in the minds of investors. Difficulty in selecting the suitable fund. Some individuals are not aware of all types of mutual funds, so they may face some kind of a difficulties of choosing the best one. Limited product range. Indian banks have remained centered around a limited product range, basically income range growth and tax saving schemes. Here they are going to make the efforts to develop and expand the market through the innovative new products. Lack of interest of the investors' education. The market success of any new product, particularly of a financial products, depends upon the largely on its acceptance by consumers. In the case of investors, mutual funds must undertake as well as design and complement programs of investors, especially aimed and investors for rural urbans as follows. Next, risk. Mutual fund schemes is investments where the conditions are not claimed and the investors cannot expect any kind of returns on those things. So fee and commission is also high when we are being compared to that of any kind of other instrument. Next concept is the net assets, NAV. Net asset is a mutual funds of the actual amount of investment which has been made by the mutual funds in issuing its, in simple term we call as a fair unit of a unit in mutual funds. It changes almost on daily basis. The value formula for the net assets is assets minus liability divided by number of outstanding units. How the cost and loads of the mutual funds will be there. So the cost will be of annual recurring cost and expenses. At the time of initial stages, it is going to incur some cost and expenses, and entry load will be there. Exit load also will be there. These are the certain cost or loading which is there on the heads of the mutual fund investors. Return on mutual funds. So they have been getting a returns which have been obtained in the period, and it could be monthly basis, quarterly, or even a yearly basis will be there. So they will be paying, making the payment of capital gains, distributing the interest or dividends. It is always calculated by taking the difference between the NAVs at the beginning period of the NAV and the ending period of the NAVs. When we consider about the problems and prospects of mutual funds, as we have discussed advantages of mutual funds, the same thing will be discussed problems and prospects with the mutual funds. What are those? That is wrong positioning, limited product range, confused market situation, absence of innovative market networking, lack of adequate research infrastructure, inefficient management, lack of investors education, lack of media support, ignorance of liquidity management, risk management encroach. So these are the certain problems which will be there under your mutual funds. Wrong perception, because they are been not been returns from the funds cannot be really compared to that of a stock market. They ignore these facts and all those things. Limited product range remain center area of a limited product, generally basically incomes, growth funds, tax saving funds, all these things will come under. Confused, that is introduction and implementations of new regulatory norms has been contributed in some measures. Absence of innovative market knowledge. So market situation has been made worse by the absence of innovative marketing techniques for the mutual funds. Agent-oriented networks has largely been failure because most of the agents have not been specifically trained to sell the mutual fund products. As per said, the lack of advocate research, the passive approach for some mutual funds is managing the investors' funds in compounding the lack of advocate research infrastructure. Inefficient management. So, a key factor of operational efficiency of any business venture, the factor that has become more crucial of service venture. Lack of investor education. The market success of any new product, particularly financial product, depends largely on its acceptance of consumer. Lack of media support. So, understanding about the mutual funds product and its features may not increase as it is found to be very low so far. Ignorance. So, ignored they often ignore the crucial importance of liability management mutual funds, which is going to overemphasize on the assets management and approaches towards this liability management has been adopted by the various funds. Risk management, which have been ignored because of the measures of the risk management, which is very complex and competitive marketplace. So, a regulatory environment of mutual funds need to encourage for these practices in India. What is AMC? That is Assets Management Company, which has been approved by SEBI, who is going to hold the fund by the way of investment different types of securities. So the trustee has the power of appointing these AMCs, and they are been either issued by the trustee or the sponsors. The assets and management companies is a private limited companies that shareholders of these companies are sponsored by joint ventures. What are the various functions of these AMCs? That is, there is register and transfer agents, fund accountant, lead managers, investment advisors, legal advisors, auditors, and the underwriters. Registers, they receive all the process and application forms of investors, certificates to investors, send refund orders, approval all transfers of units, maintain records, repurchase and redeem the units. Fund accountant, they have been appointing the fund account to maintain the proper books of accounts related to fund transaction and management. Lead managers, it appoints lead managers to attract investors, functions, and all those things. Who's going to select and coordinate the activities of advertising agency, printers, and collections, and assist the AMC in approaching the potential investor by conducting meeting, exhibition, contacts, and all those things. Next, investment advisors. Appoints investment advisor for analyzing market conditions and take decisions for investing funds. They are analyzing the security and market conditions, advise AMCs on designing investment strategies too also. Legal advisors, these are the people who is going to appoint a group of advocate and solicitors of legal advisors and pay their further services. Auditors, it appoints the auditors to verify its accounts. The key function of auditor is to inspect and verify the accounting activities. Underwriter, they are also perform the functions as underwriters. Underwriting is the latest growing trend in the field of mutual funds. It generates additional sources of incomes, which have been approved by the SEBI. So these are the certain things which will be there about the AMCs. You can expect the AMC for a short answer. What are the SEBI requirement of AMC? The SEBI requirement for the AMC is a good track record should be there, reputation, high expertise people, that is good knowledge and regarding the portfolio management, all the things should be there. Operational autonomy, the directors will hold the operational autonomy among at least 50% should have association with this trustee and sponsors. Contribution, they have to be sponsors of ANME, that they should contribute minimum of 20% of their net worth. What are the mechanism of this aim? That is, they will create the fund manager. The fund manager is a person who manage invest portfolio, buying and selling of all these things, and he will expect to manage the investor, assess prudently, and choose a particular things. Research and planning. Research activities related to securities and investments are carried out, and the results are analyzed to prepare the policy which guides investment management in futures. Creating dealers, it creates those dealers who have deep understanding of stock operations, dealers executing the transaction in stock market. So this is all about your portfolio. This we have completed the investment analysis and portfolio management, or we can call it as security analysis and portfolio management. And I'm sharing the notes in the group also for your different purpose. Even problems, solution also have shared. So refer those notes. With this, we have completed the mutual funds also, ma. I'm done with the class, sir. I'm done with the syllabus also. Anything is there, please text me. And I've shared the notes also previous one. And today's notes also I will share in the group. I am కనిపిస్తున్నాను.
నేను కన్ను పెట్టినా ఇంకేం ఇంకేం
ఇంకేం చేయాలి?
నేను కన్ను వినిపిస్తున్నాను. అయినా క్లాస్ అయిపోయిందా?
चलो. Mm.